Good afternoon. Welcome to the TheoTrade afternoon video. I'm Blake Young, and today we're going to talk about the potential signs of a return to growth. And what I'm looking at specifically, and I talked about this in the main room earlier today, is the idea that gold is a hedge for inflation and growth, while copper is just an indication of growth and demand. And so when we see gold prices go one direction and copper go another, that's usually telling us there's a problem with the economy, one way or the other. When they move together up, that is a sign of recovery or growth. And we've seen copper pull back and gold pull back, and so we saw some declining expectations of inflation. You can see my gold chart here pulling back into this key support level on the channel. And today it's trying to close up, and that's including after seeing the minutes from the Fed where they say that it's going to take longer to get this inflation under control. But regardless of what the Fed says, regardless of anything else that we'd be looking at, we're looking at the differentiation between gold and copper. And when those get out of line, that's what we want to pay attention to. And then when they get back in line together, whether up or down, that should give us a stronger trend. So as we're looking at this again, gold pulled back from 28.26, found a key support level about 25.86, repeated that support level, it went back into the uptrend, and today is trying to break through the short-term highs. If gold can sustain a break above our monkey bar and in the direction of this channel, I would expect gold is going to go back up to 27.56, potentially all the way up to 2800 this month. Now, copper prices had a much bigger drawdown, a big pullback, which was an indication that we didn't have the same demand, the same expansion that we would have expected in a global economy for the demand for copper, which is a sign of weakness in the global economy. You can see we went from $5.32 all the way down to $4. We saw about a 22% decline. We found support in this $4 range, and then over the last 5 days, we've put in a base, rallied, broke free, and this is showing a lot of strength. I would love to see it get through this high, but we are breaking through this monkey bar. At the bottom of this page, you can see I have a price ratio. This price ratio is comparing gold to copper. And what we're looking for again is when it's decoupled. And that decoupling will happen when one price is running faster than the other, one way or the other. If I look back on this for this year, you can see that we expect it to kind of go back and forth, and that can be during a trend of copper or a trend in gold. When copper gets going too fast, that means this came out of its normal pattern and accelerated to the downside, which means copper was growing a lot faster than gold. That's a sign of growth without inflation. That is a lot of demand, and we saw a really robust early move in the year. After that, however, copper peaked, and therefore copper and its ratio bottomed out here, and gold took control. At that point, this trend again cleared out the normal and accelerated too fast, too far. That would be gold climbing, copper falling, and that's a sign of stagflation. The fact that we've turned the corner here and are breaking down, if we drift back down to a normal ratio of copper to gold, and we see gold going higher and copper going higher, that is the recipe for some growth. And so what I'm looking for is I'm looking at those stocks inside of basic materials and inside of industrials. If this is the base of this pullback, if this is the base of global demand and we see things stabilize, I'm looking for prices in basic materials and inside of industrials to go back up. I'm not saying all the way back to the previous highs, but I'm looking for the strongest of the strong if this is the sign of a recovery. That recovery still needs to see gold break through that monkey bar. It'd be nice if copper broke through its high, but this is where I'm going to start looking at individual stocks. Stocks that are discounted would be things like FX or FCX, and also breaking free today, despite the market rising, falling, and kind of trading in a very volatile sideways pattern. FCX has been discounted and is breaking free. We do know we have earnings here, but there are multiple strategies of buying the stock, writing it out through earnings, and letting this get back all the way up to 44. I'm looking for a 10 to 15% bullish move in FCX. If we look at Dow Chemical, Dow Chemical is still in a free fall, but when this stops falling, That's where I'd be looking for a highly discounted opportunity in Dow Chemical and looking for the lower cost and an increase in demand. But until it breaks free, I don't want to step into that. But when it does, it should have a fairly positive move in Dow Chemical. If we look at the industrial stocks, they've also pulled back and are trying to bounce off of these near-term lows. And to find the discounted stocks inside of here, if we see a recovery, I would be looking at Caterpillar. Let it stop falling, break through this short-term red high about 370, and we likely go to 392, but possibly all the way up to 405. I'd be looking for that move over the next month. Deere, holding at previous resistance and support. If it bounces and closes higher, I'd be looking for a move from 410 up to 440, looking for about an 8% climb there. One of the ones that's probably most interesting to me is UNP, Union Pacific, because if we're going to see an increased demand in products, if we're going to see an increased demand, especially in commodities and ore, then this would be one you're going to see a lot more demand in transportation, like UNP. UNP has already recovered off of its lows. It created this nice widening pattern, became discounted. Again, we have earnings coming up that we have to pay attention to. But if we can get through yesterday's high, I'm looking at UNP going back to 240, probably even to 250. It doesn't seem like a lot, but it's an 8% move and what I consider a fairly low risk opportunity to trade back into industrials. This is not a guarantee of long-term trends. This is simply something that I've seen that shift in gold and copper. I'm still concerned about the consumer. I'm still concerned about global demand. I'll be talking about the consumer and debt tomorrow, but as this is setting up, I'm looking for short-term confirmations to step back into industrials, to step into basic materials as the discounted plays that could make us anywhere from 5 to 10% this month, as well as possibly returning to previous highs if we are truly seeing a return to global demand. That's going to do it for me today. Have a great day. Join us tomorrow as we do our special event, and then also join Brandon and I on Friday as we do our TheoTrade Live and talk about non-farm payroll.